Hi and welcome to Swissquote's Daily Market Talk. It's Friday, December 6th. The French political turmoil is abating with no reasonable end to the French political deadlock, but no one seems to be stressing about it. So the European stocks are up, the yields are down, and the euro extends its gains versus a broadly softer US dollar on hope that today's sufficiently weak jobs data from the US will probably cement the idea of one last cut before we go. So against all odds, yesterday ended up being a good trading day, at least for investors who have exposure to the French assets. Because the French government, fell and the political uncertainty in France shifted to a higher gear. Yet the French 10-year yield eased yesterday, the euro gained ground, and the CAC 40 hasn't had such a good week since September. Now, some say that the fact that the French political turmoil increases the chances of more European central bank support is helping the French and the broader European indices to do well. But the gains that we see in the euro go against that theory. And others say that Le Pen's comforting words that France could overcome this crisis and even deliver a budget in a few weeks with a slower deficit reducing path, of course, have been, quite soothing for the investors, for the market's nerves, and triggered a relief rally. Now, a relief rally is a big word. That's a bit of a daydreaming, in my opinion, given that the job of getting a budget plan improved will probably be as hard for the next government in France than it has been for Barnier's. And note that the next PM should send the new 2025 budget proposal to the president by December 21st, so that's quite tight. And Le Pen also said that Emmanuel Macron doesn't need to resign, and it's made the headlines in a good way. But from what I heard at the French TV, it mostly sounded like he doesn't need to resign if he wants to sit in a divided government, handcuffed, and wait until his term ends. But anyway, whatever it is, even chaos in France looks elegant, at least from the market perspective. The same thing would have happened in Greece, God forbid. So we can say today that all is well that ends well. The market is clearly in a much better mood today, this Friday, than it was the same time last week when the French government was just about to collapse. Now that it collapsed, we're all good. And to end this week with a sugar coating, the Eurozone is expected to print a better looking growth number in the third quarter. The yearly figure there could be revised up from 0.6 to 0.9%. And the latter could help the euro finish up the week on a better note. The euro dollar is preparing to test the 106 resistance level. The pair could eventually find enough energy from the euro leg to break the back of these 106 offers. But obviously the US jobs figures and the US dollar's next direction will say the last word of the week. Now, for that, the US dollar index came swiftly down at yesterday's trading session on the back of a higher than expected jobless claims number last week. Released earlier this week also, the US jobs data showed higher job openings in October, but lower than expected private job additions in November, so a lower than expected ADP number for November. In summary, the jobs data from the US so far this week was rather mixed and didn't lead to an important sentiment change regarding the Federal Reserve expectations. The Fed is still expected to cut its interest rates by another 25 basis points when it meets this month, with a 72% probability attached to this scenario. Today, the official jobs data from the US will land on the market and is expected to print a strong NFP number of around 200,000 new non-farm job additions for November, but investors are ready to disregard any strength that we might see on the NFP front, given that last month's figure will probably be impacted by the hurricanes and the strikes of the month before. So we will be keeping a closer eye on the unemployment rate, which may have slightly deteriorated from 4.1 to 4.2% last month, and the wages growth, which may have slightly eased from 0.4 to 0.3% on a monthly basis. Now, the market and the US dollar traders are in quite a good mood to send the US dollar lower these days. So, US jobs data, in line with expectations or ideally softer than expected, should easily lead to a further US dollar depreciation across the board into the weekly closing bell. But if the US jobs data today shows any surprise strength, well, Jerome Powell's mostly ignored remarks this week about a remarkably strong US economy and decreased risk in the US jobs market will come back to the headlines and could eventually spoil the mood into this weekend. Let's see what happens, fingers crossed. Now, other news that are worth talking about is OPEC news, because as widely expected by the market and the participants, OPEC announced another 3-month delay to its production restoration plans yesterday. It is now planned for April, a full year later than the initial plan. And OPEC also said that the restoration will be slower than previously imagined. This is also the third time that the cartel delays the end of its output restriction plans. Now, it's good, but the problem here is the oil bulls are not convinced. They are not really impressed because OPEC's decision to delay its production restoration plans won't avert a global surplus that the IEA expects to stay about 1 million barrels per day throughout next year and a little lower than that during the third quarter of next year. So, unfortunately for OPEC, their announcement yesterday was fully priced in and kept the bears in charge of the market yesterday. The barrel of US crude remained offered near the $69 per barrel level, and the bears target a further fall toward the $65 to $67 per barrel range, with the OPEC decision now behind us with not much surprise. In the equity space, the S&P 500 and Nasdaq 100 both consolidated gains yesterday near their all-time high levels, while the S&P 500's equal weight index underperformed its normal weight version throughout this week, and that was on the back of a rebound that we saw in technology stocks. Now, the market narrative is still in favor of a broadening market rally toward the non-technology pockets of the market, and that on the back of resilient US growth and softer financial conditions from the Fed. Therefore, the short-term divergences between the equal weight and the normal weight indices are interesting buying opportunities for the equal weighted index. And the buy the divergence rhetoric is also giving some support to the European equities these days. The STOXX 600 index actually performs surprisingly well this week for a continent that goes through important political and economical struggles, mind you. So the rally in the DAX index, if you look at it, defies the walkout that we see in Volkswagen factories, for example, the dire economic fundamentals in Germany, and the upcoming snap election there as well in February. So it's all about the falling yields and the European Central Bank expectations and the divergence, full stop. What will the European Central Bank do next week? Well, the consensus is another 25 base point cuts, but many expect the European Central Bank to shift its focus from inflation that it considers on path to their 2% target to economic growth. So the conclusion of this week is the stocks go up when the economy is strong, and they go even higher when the economy is weak. So this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. Follow us on Instagram, on X and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week. And until then, good day trading and have a lovely weekend.